Right now, somewhere in America, someone is standing in their kitchen, coffee in hand, staring at their phone because silver just dropped almost $2 in a single morning. Their first instinct is panic. Their second instinct is to sell. But here's the strange part. The move that scared them wasn't really about silver at all. It was about something happening thousands of miles away in a region most silver buyers never think about. And that disconnect is exactly why so many investors keep getting this metal wrong. Silver has had a wild stretch lately. It's traded above $60 an ounce, pulled back below 59, then bounced right back near 60 again, all within the space of a couple of weeks. Headlines blame airstrikes. They blame ceasefires. They blame the dollar. And technically, all of that is true. But if you only watch the headlines, you're watching the weather instead of the climate. You're reacting to the daily gust of wind instead of understanding why the storm is forming in the first place. Before we go further, if you find this kind of grounded, no-hype market breakdown useful, take a second to like this video and subscribe to Smart OG John Ag. It genuinely helps more people discover thoughtful financial education instead of another loud prediction channel, and that's really the whole point of what we're building here. So let's start with what actually happened. Over the past couple of weeks, tensions escalated sharply in the Middle East, with strikes and counterstrikes affecting shipping routes tied to global energy supply. When energy routes get disrupted, oil prices tend to jump, and when oil jumps, inflation fears usually follow close behind. That's the chain reaction that hit silver. Rising inflation worries pushed traders to bet the Federal Reserve might raise interest rates again this year. And higher interest rates historically make precious metals less attractive compared to interest-bearing assets like bonds. That's the textbook explanation. But here's what most investors never realize. The textbook explanation is only half the story. Think about what silver actually is for a moment. It isn't just a shiny safe haven metal like people often assume. More than half of silver's demand comes from industrial use. Solar panels, electronics, medical equipment, electric vehicle components. So silver sits in this strange middle ground between being a monetary asset, something people buy out of fear or as a hedge against inflation, and an industrial commodity, something tied directly to how fast the global economy is building things. Gold doesn't really have that problem. Gold is almost purely a store of value. Silver has to answer to two very different masters at the same time, and that's exactly why its price swings can feel so much more dramatic than gold's. Picture an investor named someone very ordinary. Let's just say a retired schoolteacher in Ohio who bought silver coins 2 years ago as a way to protect her savings from inflation. She watches the news, sees silver slips on renewed rate hike fears, and immediately feels her stomach drop. That emotional reaction is completely human. But here's the part that changes everything. If you zoom out from that single week and look at silver over the past 12 months, it's still up more than 50%. The daily headline and the yearly trend are telling two almost opposite stories, and only one of them actually matters if you're investing for the long run instead of trading for next Tuesday. This is where market psychology becomes just as important as market mechanics. Most people don't lose money in silver or gold because the asset itself failed them. They lose money, or more accurately, they lose potential gains because they buy when everyone is excited and sell when everyone is scared. It's an old pattern, and it repeats across nearly every market cycle in history. Silver has done this before. Sharp climbs followed by sharp pullbacks, followed by renewed climbs, especially during periods when inflation concerns and geopolitical uncertainty overlap the way they are right now. There's another reason the market may be reacting this way, and it rarely gets mentioned. The US dollar has been unusually volatile lately, swinging based on shifting expectations about Federal Reserve policy. Silver, like most commodities, is priced in dollars globally. So when the dollar weakens, it often takes fewer dollars to buy the same ounce of silver from an international buyer's perspective, which can support higher prices. When the dollar strengthens, the opposite tends to happen. This relationship between the dollar and precious metals is one of the most consistent patterns in market history, and it's often more predictive of short-term price direction than the news headline sitting right above it. Now here's something worth sitting with for a second. Federal Reserve officials themselves have recently pointed to an unusual driver of inflation that doesn't get nearly enough attention: demand fueled by artificial intelligence investment. Massive spending on data centers, computing power, and infrastructure is pumping real dollars into the economy, and that kind of investment boom can quietly stoke inflationary pressure even without any geopolitical conflict at all. Most headlines focus on one story, usually the most dramatic one, while the real signal may be somewhere else entirely, humming quietly in the background. Let's talk about what experienced investors tend to watch instead of headlines. Many long-term precious metals investors pay closer attention to real interest rates than to the raw interest rate number itself. Real interest rates simply mean the interest rate after subtracting inflation. When real rates are low or negative, meaning inflation is eating up more value than the interest you're earning, gold and silver have historically tended to perform better, because holding cash or bonds starts to feel like a losing proposition. When real rates rise meaningfully, that historical tailwind for precious metals tends to fade. This single number often explains silver's mood far better than any single day's news story. Later, we'll look at one indicator many everyday investors completely overlook, something that has quietly signaled major shifts in precious metals before the headlines ever caught up. But first, let's talk about risk, because no honest financial conversation skips this part. Silver is not a guaranteed path to wealth. It has historically underperformed the stock market over very long stretches of time, sometimes dramatically so. It doesn't pay dividends. It doesn't generate cash flow. Its value comes from scarcity, industrial demand, and how much trust people place in it during uncertain times. That makes it useful as a piece of a diversified portfolio, particularly as a hedge against inflation or currency weakness. But it's rarely wise as someone's entire strategy. If a video, an article, or anyone online tells you silver or any asset will definitely hit a certain price, that's a signal to be skeptical, not excited. Nobody can promise that, no matter how confident they sound. So what should an everyday investor actually watch instead of panicking over daily swings? Here's the indicator we mentioned earlier. Many experienced market participants track the gold-to-silver ratio, which simply measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, when that ratio climbs unusually high, meaning silver looks cheap relative to gold, it has often, though not always, preceded periods where silver catches up in performance. It's not a crystal ball, and it doesn't work on a predictable schedule. But it's a far more useful long-term compass than reacting to whatever happened in the news this morning. And this is where things become really interesting. Silver's recent volatility isn't just noise. It's actually a reflection of how tightly interconnected today's global economy has become. A conflict affecting oil shipments in the Middle East can influence inflation expectations in the United States, which can shift Federal Reserve policy expectations, which can move the dollar, which can move silver, all within the span of a single trading week. Understanding that chain doesn't make you a fortune teller. It makes you someone who understands why the market moves instead of someone who's simply startled by the fact that it moved at all. It's worth pausing on how different this feels depending on who you are. A 32-year-old investor just starting to build a portfolio has decades to ride out silver's ups and downs, so a rough week barely registers in the bigger picture. A 68-year-old retiree relying on savings for income sees the same headline and feels something much heavier, because their time horizon is shorter and their tolerance for sitting through a drawdown is naturally lower. Neither reaction is wrong. But it does mean the right response to a silver dip isn't universal. It depends heavily on your age, your goals, how much of your portfolio is actually tied to precious metals, and how soon you might need to access that money. This is exactly why so many financial educators, including channels like Smart OG John Ag, keep repeating the same idea in different ways. Context matters more than the headline itself. There's also a quieter historical pattern worth knowing about. Throughout past decades, periods of heightened geopolitical tension have often coincided with short-term spikes in precious metals demand, followed by a cooling-off period once the immediate crisis fades from headlines, even if the underlying economic pressures, like inflation or currency weakness, remain unresolved. In other words, markets often overreact to the loudest story of the week and underreact to the slower, less dramatic forces working in the background. If current conditions continue, many analysts believe the underlying inflation and monetary policy questions will matter far more to silver's medium-term direction than any single week of Middle East headlines, however dramatic those headlines might feel in the moment. Let's bring this back to something practical. If you're someone holding silver, gold, or other precious metals right now, what actually matters isn't Wednesday's dip or Friday's bounce. What tends to matter more is your original reason for owning it in the first place. If you bought it as a long-term hedge against inflation and currency devaluation, then short-term volatility is simply the cost of admission, the same way stock market investors accept occasional double-digit corrections as part of long-term investing. If you bought it hoping for a quick flip based on a headline, that's a very different strategy with very different risks, and it's worth being honest with yourself about which category you actually fall into. Historically, market research suggests that investors who check their portfolios less frequently during volatile periods tend to make fewer emotionally driven decisions. That's not a guarantee of better returns, but it's a consistent behavioral pattern worth knowing about yourself. The retiree in Ohio checking her phone every hour isn't protecting her wealth by watching closely. In many cases, she's simply increasing her own stress without changing the outcome at all. Let's quickly recap the pieces that matter most here. Silver's recent price swings have been driven by a mix of geopolitical tension, inflation expectations, Federal Reserve policy speculation, and dollar strength, layered on top of silver's unusual identity as both a monetary asset and an industrial commodity. The daily headlines tend to focus on the most dramatic single cause, when in reality it's almost always several forces interacting at once. Experienced investors tend to zoom out, watch real interest rates and the gold-to-silver ratio rather than daily price swings, and treat volatility as a normal part of holding a historically volatile asset rather than a reason to panic. Before we close things out, I'm genuinely curious about something. What's your current outlook on silver right now? Do you think this recent pullback is a temporary reaction to geopolitical noise? Or do you think there's something bigger building underneath it? If you already own gold or silver, how are you personally approaching this kind of volatility? Drop a comment and let me know. These conversations are honestly one of the best parts of building this channel, and I read through as many of them as I can. If this breakdown helped you see today's market a little more clearly, consider sharing it with a friend or family member who's also trying to make sense of gold, silver, or the broader economy right now. Financial education tends to spread best person to person, not headline to headline. As we wrap up, remember that markets like silver reward patience far more often than they reward panic. The investors who tend to do well over long periods aren't the ones who correctly predict every short-term swing. They're the ones who understand why prices move, size their position sensibly, and stay grounded when the headlines get loud. Thank you for spending this time with Smart OG John Ag today. Keep learning, stay patient through the noise, think in years rather than days, and always make sure any investment decision you make is based on your own research, your own goals, and your own comfort with risk. I'll see you in the next one.